Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracy Reinick, and this week I have Zach's Kevin Cook on board to discuss everything going on with the banks. There is a lot going on, so I had to turn to Mr. Cook to help us navigate what's going on, especially because I noticed that in one of his newsletters, the Taser newsletter here at Zach's, he bought the regional bank ETF on March 13th. That's the day after the weekend, after the feds had to step in and put a little bit of a backstop on some of the banks, and he went in and bought that. So I want to know why were you buying it then? And we're getting a bit of a bounce in the banks here, but will it last? Should you invest in the banks like Kevin did? Should you stay away from those stocks? What is going on out there? So Kevin, welcome.
Hey, Tracy, good to be here.
So let's talk about your Taser buy. What made you decide on March 13th after, the doom and gloom of over the weekend? Twitter was very gloomy. I had to actually kind of stay off of Twitter because the sky was falling. Contingent was out in full force, and understandably because Silicon Valley Bank had been taken over by regulators before the weekend, and then Signature Bank of New York was also closed by regulators over that time period. And so we had two of the biggest bank closures ever, other than Washington Mutual. These other two were the second and the third largest. And so it did seem pretty gloomy, but then the Fed did, come up with a plan, and they backstopped those deposits and said that all the deposits would be paid in full, basically insured them. And then the market felt a bit better on that Monday, but still we had a big sell-off in the rest of the banking stocks on that Monday on March 13th. And you stepped in to buy the KRE, which is one of the regional bank ETFs. So what was your thinking?
So I guess I've seen this movie before where there's just unbridled emotional panic in a very short amount of time. And, this ETF holds about 140 US regional banks. And so I'm pretty confident it's not going to zero. And so when it was down 4% in one day, and then 8%, and then 14% on Monday, as this fallout and this contagion and this panic continued, to me, it's one of the favorite trades that I look for. Now, when your favorite stock goes on sale, let's say your favorite stock has a bad earnings report or some revelation, and it's down 25%, you're emotionally, you might want to buy it, but you still hesitate because you're not sure what's going on. With an ETF that holds 140 regional banks in the strongest banking system in the world, arguably, you can have a certain level of confidence. Like, it's never been down 14% in one day before after coming off, 15% in the previous 2 days. So, and then we had the government come in and backstop, as you mentioned. The Fed, the Treasury, Jay and Jan, they got together over the weekend, and they brought the nukes essentially to the rescue.
Right.
So you've got this diversified instrument that is, I don't know if you could call it the backbone of the U.S. banking system, because we'll have to let the big guys be the backbone. But in a sense, the regional banks are like, the muscle and tissue of our financial system. Without the smaller banks, you don't have as much liquidity and opportunity for small business.
Yeah, for sure. And I think that's one of the reasons why they did let up on the regulations with some of them in 2018, because they felt like, they were, on the right track, but you didn't want to keep it too tight on their lending conditions because they are such a big driver, as you said, in their individual regions. And you need the capital to have the growth in those regions. I did want to say something about the KRE that you bought, and that what makes it interesting as well is that Silicon Valley Bank, the ticker was SIVB. That was KRE's largest holding, and that went to zero, but the rest of the ETF just kind of kept trekking on. That's the good thing about ETFs, right?
Yes.
And that's why I feel like they are a good alternative in these kind of panicky situations, because you are buying the basket of them. You don't have to guess like which bank might be hit next. No, because you're buying over 140 of them, you said.
Yeah,
so
and people have to be careful in the pursuit of diversification that there's all different types of diversification, right? And so we've learned the hard way that a mutual fund that just has the same 5 top holdings as the big tech QQQ, you're not really diversified, right? If it's Microsoft, Apple, Facebook,
right,
Google, that sort of thing. So that's not really diversification. And then an ETF that is concentrated in one sector or industry, well, you're not diversified across the whole economy. Because you're concentrating in a sector or industry. But if you are making a bet on the regional banks being collectively down 50%, then you're saying, okay, I'm going to buy this basket, and I'm not going to try and pick which individual regional bank is going to make it. For instance, I was looking at buying Charles Schwab last night, doing my homework there and thinking about buying Charles Schwab. We could talk more about them later, but it turns out, the stocks were up this morning, so I didn't have the chance to buy the fire sale. But yeah, you've got that diversification among all the regional banks because you're making a bet on the system working the way it's supposed to and overcoming this panic. Now, it was a little troubling this morning, though, or yesterday morning. Like, we get this backstop from the Fed and the Treasury over the weekend, and they surprise us and take out Signature Bank too. But First Republic, the California bank that tends to cater to higher net worth, FRC is the symbol. They go by sometimes called FRB, First Republic Bank, but FRC is the symbol. That stock plummeted 65% on the open on Monday morning. I mean, that was terrifying if you were involved because it was like another forced run on the bank, right? It's like the old run on the bank was where everybody stood out in line, give us our money. But nowadays it can be done electronically, and you've got big names on Twitter like Peter Thiel and Bill Ackman, sort of yelling fire in a crowded theater, accelerating the panic and the sharks on Wall Street. They could smell the blood in the water, and so they went for First Republic, and so it was nice to see that First Republic bounced back today a little bit. I saw it was down 62% yesterday. Last time I looked, after a big bounce, it was up 35% today.
Now, a lot of these are heavily shorted now, so it's going to be super volatile in a lot of these stocks. But what do you make of some of these others that I'm just kind of surprised, but maybe I shouldn't be? I mean, the whole industry got hit. It didn't matter if your bank was in, Chicago or Houston or wherever. Everybody just sold all the banks. So that was a given. But some of these, everybody's looking at the West Coast banks for the most part, and those have taken the huge hit. And I saw today on March 14th that Citadel took a 5% stake in Western Alliance. That one is ticker WAL. It is on the list that they're always showing on CNBC and the other business networks of one that, was down heavily. It's up on March 14th by 22% in the rebound here. But What do you think about some of these bigger investors coming in now, like you did yesterday?
Yeah, I mean, it makes sense. Like I told you, I was looking at Schwab last night, and then it was up this morning. And one of the reasons in the column here is that Ron Barron of Barron Asset Management, he was on CNBC saying he bought Schwab yesterday. So that's a confidence buy from a large, successful billionaire investor who's done very well in a lot of things. So
yeah,
no, that's encouraging. So basically, he was more courageous than I was, because he could say, no, this is a quality company that is really beaten down. And I've spent a little bit of the afternoon here looking at Schwab's last corporate presentation in late January. They did their winter update, and it's a 150 slide deck, because I'm trying to figure out, okay, Schwab is unique. Schwab is not your average regional bank. They were first of all a brokerage,
right.
And they have and they have ETFs. They've got institutional money, high net worth. They acquired TD Ameritrade. What shocked me is I didn't realize how big Schwab was. They have $7 trillion in total client assets, which is about as much as JP Morgan and Bank of America have combined. So,
wow.
And so I was looking through this presentation because I want to find out, okay, what percentage of their total assets is bank deposits, and sort of trying to uncover that. I'm not a bank analyst. What we really need right now is, obviously we need everybody to slow down and hopefully don't let the short sellers win. But investors like us, we need to learn about how the banks got caught on the wrong side of accumulating treasuries and agency mortgage-backed securities, at under 2% yields, and then putting them in the hold to maturity bucket, while rates rose the fastest they ever have, in 4 decades, practically, from 0 to 4%. And what kind of stress that put on them? I mean, basically, it ripped their face off in terms of having any capability of net interest margin or the ability to keep deposits. In 22, Schwab saw their bank deposits go from about 440 billion to 367 billion, about a 77 billion outflow, and they call it cash sorting, when investors are just seeking higher yield because rates have risen. So that's the dynamic that the analysts need to be they need to go into each balance sheet of each of these banks, whether it's Western or First Republic or whatever, and explain to us, okay, what is their leverage situation and how underwater are they? And if their net interest margin is below the T-bill rate, how long is it going to be that way?
Right. But even just reading some of the analysts who have looked at this going back months ago, like there was a Wall Street Journal reporter who looked into all of this in November of 2022. And even he had a nice chart in there talking about which banks had the most exposure and all of that. But his basic conclusion at the end was it doesn't matter because they don't have to market to market the losses unless there's the bank run. And, he wasn't assuming that there would be a bank run, but that was when rates were much lower, and he wasn't putting into play that all of us, are sitting there with 0% on our savings account, if we even have a savings account. Some people don't, but if you do, you're sitting there with 0. And I did think that this was interesting. I saw a tweet on this from one of the finance guys talking about how the consumer didn't really notice when the rates, that you could get on like a CD or something went to 2%. They didn't really care when they went to 3. At 4%, some people started noticing, especially retirees, baby boomers, silent generation, who were looking, they want the yield. They started seeing 4%. They started getting these offers from their bank for CDs for 4%, or a a brokerage like Fidelity started paying 4% and word started spreading. Like, I'm assuming in the villages, for instance, in Florida, like suddenly everybody's like, texting each other in the villages, like, hey, you could get 4% at Fidelity, right? I'm assuming that is what happened because I heard all about it.
That's why they call it cash sorting. That's their terminology for it, because it happens gradually. It's sort of like the proverbial frog in the boiling pot of water. Oh my gosh, I just noticed that, money market rates are 4 or 5%.
Right. And you hear from your friend that you can get this at this other place. So then you decide, I'm going to move my money. That is what ended happening. All of them, all of us started moving our money all around. And for whatever reason, a few of these select banks didn't assume or understand that would be the human behavior, that we would try to get it. And they're still paying the super low amount on their savings accounts. So there's no reason for you to stay there. And now with, it used to be harder to change your account. You would have to go into the bank branch and close it and then go to the other one, open it or whatever. So you might not have done it, or at least not as quick. But now everything is electronic. You can probably just basically do it all online. So it's easy to move it somewhere. And I'm sure Schwab saw some people like, hey, I'm getting out of Schwab. I'm going to go over to Fidelity to get that 4%. Why wouldn't you? Right. But now I saw Mike Wilson, the Morgan Stanley analyst, I saw on your Twitter feed that, he's saying the banks are going to have lower earnings now going forward, at least some of them, because they're going to have to match in order to keep my money now. They've got to give me the 4%. They can't just keep me at 0.03 or whatever it is. Savings.
And this is where their business gets more difficult because they're losing deposits and they can't afford to pay, those market rates because they're getting killed on. They basically, instead of a net interest margin, they have a negative interest margin.
Right. In some cases, yeah. This is really where you have to know, like you were saying, you have to really know what your bank is doing. Like, where are they invested? Are they in those longer term maturities, or did they do the short term? Like, I've seen some bank CEOs, they've gone on CNBC to talk about their business because they know people are nervous about every bank. So they're out there talking about what they're in. And several of them are saying they're not even in the long term. They're in the short. So that's what you want.
Yeah, that's good news. Yeah, because like you said, you saw the Journal article from November where the analysis was, hey, we're not in trouble because we're going to hold these to maturity, so we're not really marked to market on them. They're unrealized losses, and they don't count against us. Well, that's only if they put them in the column called hold to maturity, or HTM.
Yeah.
And then the other column is AFS, available for sale, where they will get dinged, but if they need the liquidity, then they have to sell.
They have to sell them. Right. And that's what happened to Silicon Valley Bank. Suddenly everybody went in there and $42 billion was yanked out in one day. They did not have the cash sitting there. They had to sell some of these longer term investments to get it, but they have to sell it at a loss at that point. So then it just spirals down. They can't handle the run. And then more people run in, and then it gets worse. So yeah, it was not good. So, suffice it to say. And
I mean, as painful as this is for, I'm not worried about the taxpayer footing the bill here because, FDIC had some money saved. It obviously reeks of moral hazard, again, for the Fed and Treasury to do this. The people I'm most worried about are the small startups that, they're not West Coast elites. And we read about that woman, that mother of four in Ohio, a founder with 15 employees with some new software for families who work from home. And she tried to move her money out of SVB on Thursday, and she missed the window by 20 minutes. So she was devastated over the weekend about whether she would be able to pay her 15 employees. So it's those kind of stories, about the people who get hurt. So the only small upside I want to say here is that hopefully this makes more investors more educated about banks and the banking system, and understand fractional reserve lending and understand what banks have to do with their balance sheets. Obviously they would love to, borrow short and lend long and gain a nice net interest margin, but we had an unprecedented event where we were just getting ready to come out of QE and then shut down, and they flood the economy with money and kept rates at zero. And all, like, for SFB, their assets tripled from 2019 to through 2021. And what were they going to do with that money? They couldn't invest it fast enough, so they just bought treasuries and MBS at 1.5%.
Yeah, it was some of these banks had the benefit of all the IPOs and the SPAC money all just like flowing in there with whatever else was going on in the economy. But won't it have the reverse now? We're going to see real tightening, at least in Silicon Valley. We were already seeing it anyways with the tech layoffs and, them easing on their growth trajectories. But now you're really going to see it because this bank had been around for 40 years. And it lends out to a lot of small startups that now where are they going to go? There will be replacements, but it's going to take a while and everybody's going to be real cautious. And then even with Signature Bank, I didn't realize this until I got an article from the Hollywood Reporter about how Signature Bank lends to Broadway. So it's like a similar thing to the creatives. And they do have a backup bank in, I think it was City National, which is a subsidiary of the Royal Bank of Canada, they said. And it's used, City National is used a lot in Hollywood as well. So they could go to the backup. So maybe we won't see as big an impact on, the Hollywood and those creatives. But you've got to think that there's going to be even more of a tightening on it, though. Even though City National, they're just
you mean in the sense of how loose
underwriting
VCs are with their money, right?
Yeah.
And maybe that needs to happen. I don't know. Is it going to kill technology innovation? No, but it's going to hurt a lot of small startups that were, 2 or 3 person shops that got their first 2 or 3 million that were trying to get, go to their next round and.
Right.
So it's just going to make it harder. It's going to make people more accountable. One of the, people should follow both of us on Twitter. You're at Tracy Reineck. I'm at Kevin B. Cook. Yep. But one of the best Twitter finds, as we share news, and like Twitter is great because I call it communities of knowledge, where you have people who are relative experts sharing research and resources and getting vetted by their peers. So it's not fake news. It's like, okay, here's this research. What do you think? And then we all talk about it. And one of the best accounts was Raging Capital Ventures, at Raging Ventures, who did the analysis of Silicon Valley Bank in January. Like, this is a big heads up.
Right.
So here's somebody who did their homework. So, people should find that tweet. It's pinned at the top of his Twitter feed, at Raging Ventures. And it's just, I don't know if it's 10 or 15 tweets in a thread, but it helps you understand the mechanics of these balance sheets. And obviously, Silicon Valley Bank, we can say that was the Wild West, and venture capital, and they played fast and loose and yada, yada. But, so to a lesser degree, the same themes exist for a lot of small banks who got caught, buying long dated stuff at low rates and now having to pay up for deposits or just lose the deposits.
I do think there's a difference, though, between these bigger regionals that, over 10 billion and some of the smaller regionals or your community banks. The community banks themselves are still really, really regulated by the Fed and they're super regulated. I feel like there was this kind of missing part in the middle where they did loosen the regulations on them in 2018, but the guys on either side, the big guys, the too big to fails, like the JP Morgans, were not loosened, and the community banks were not loosened. So most of the issues with this issue is in those bigger regionals, and that's it.
Yeah, well, since you just brought up the big R word, I was making a list of our topics for the today, and I was like, all those words were started with R, like regionals, runs as in bank runs, rates as in interest rates, and then regulation is the big one that you just brought up. Obviously, the powers that be, there's going to be a whole big argument in Washington about, well, we need more regulations again for the banks. And is that going to hurt or help, do you think? Do you think we're going to get some positive moves here? Or will it I don't know, will it hamstring lending?
I think it'll be positive because the underlying issue was really their investments. It wasn't in the actual lending standards. And that's a difference too. That's the big difference with 2008. In 2008 was the actual underlying assets were blowing up, not where they were putting the money. So, I feel like they're all doing pretty well on that side of things on underwriting, but I do think everybody is kind of obsessing, and rightly so, with what's happening right now with these scenarios. But a bigger issue may await us a year from now, 2 years from now. I don't know how long, in the underlying assets, and maybe presumably with real estate assets and on the commercial side. So, there is going to be ramifications for the Fed raising as quickly and as high as they are on the lending side, on the asset side. And we all know with commercial real estate, a lot of the big cities are still struggling. It's, only 50% of the employees are back into the downtown areas of most of the major big cities. And the office buildings just aren't, being occupied. A lot of the tenants can go in and negotiate whatever they want, the lower rates now. That's all going to start to hit the the
that's that hasn't come home to roost yet, except we just saw in the past couple of weeks, it hasn't made like major headlines, but you'd catch it on Bloomberg or something, where a major equity fund all of a sudden missed an interest payment, on the 6 office buildings they own in San Francisco or wherever. We're going to probably see more of that, because those vacancies, I mean, if they were expecting people to come back to the office, it hasn't happened, right?
Right. So who's holding all that paper? What's going to happen when that comes home to roost? That comes down to the underwriting. But already we're starting to see, we've started to see some foreclosures on like hotels and various things, which is, you might be surprised to hear that it's on hotels, but they got hammered very harshly at the, first year or two of the pandemic in the big cities. And some of them just could not really recover, even though travel has picked up again. So we're starting to see that, but who's going to take the hit on all of that? What banks were lending and that? What REITs hold the paper? That's something that people are really going to have to watch when they are looking at a bank as well, I think. Like there are certain banks that are more heavily invested in certain markets and certain areas on the commercial side, or even apartments. There was a lot of apartment buildings being built in the last 3 years. Did we build too much in certain cities? Could some of them get into trouble? We don't know. But I do think some of this is going to come down the pike on the real estate side. And so I guess coming back to kind of how we started this, you bought the KRE because you felt like that was, there was panic. It was a good time to jump in there. But now, we're seeing a rebound. should anyone even be trying to get into any of the individual stocks? I know, like I mentioned, Citadel got in there. These are the big professionals. You said Ron Barron got into Schwab. You were looking into Schwab, but now you're on the sidelines still waiting. I own a couple of the regional banks in my value investor portfolio. We didn't do anything. They weren't the ones that are getting the most hit, but they did get hit. But should we even be in them? Should I be selling even the ones that, aren't at the epicenter, just to take the risk completely off the table? What should investors be doing?
So I think if you want to play in the space and you don't know enough about any individual regional bank, then the KRE is the way to go. Okay. Then my next choice would still be Schwab. Just because, Schwab has a, they're building an ecosystem and a forward-looking strategy to be not only to collect assets and gain new clients from younger generations, but to serve the wealthy. And they're doing this direct indexing, which they project to grow quite a bit. So Schwab has a long-term growth plan that I really like. And it's currently a Zach's number 5 rank, just because estimates came down for a lot of these places. But that would be my second choice. And you were talking about looking ahead in the next year or two here, what's going to happen as more stones get unturned and either rates stabilize or whatever. Schwab has a great chart in their investor deck here that where they plot their net interest margin against where they think Fed funds is going to be. So, and they go out to 2025. And right now, we've got 4.5% Fed funds, and Schwab's net interest margin is 2.25%. Okay. So, and they project that by 2025, their net interest margin could be back to 3%, but they also project that Fed funds could still be above 3.5%. So, this is the kind of modeling and projections that these banks have to do, especially when they've got large balance sheets with lots of different assets, with different maturities, and either government or agency. One funny story I want to tell you is that I went back and I found an old research report about Silicon Valley Bank. It was from November, and it was by a big name bank analyst. I won't say who it was, but he was said, okay, here's what's going on with Silicon Valley Bank. And, they've had a tough time, and, valuations are down for all these, private startups. I did that podcast a couple weeks ago with the fintech guy, Steve McLaughlin of Financial Technology Partners, and we talked about when these private companies have to do a down round. And a down round is essentially you're underwater on your peak valuation, and you have to raise money at a lower valuation now. Well, this analyst thought that would be a good situation coming up for Silicon Valley Bank, because all these startups were going to start running out of cash. They were burning through their cash, and they were going to have to do new down rounds in 2023, and that would bring deposits back for Silicon Valley Bank. Well, that bit of hope didn't happen.
No, not at all. I do want to kind of finish up by reminding people that the U.S. banks have FDIC deposit insurance, and it's up to $250,000. So if you have money in that bank under $250,000, you are insured. That's the whole point of the FDIC. And now the Fed program has lifted that higher for the banks that they just had to close. So those people are also going to get, fully insured on what they have. But also something to keep in mind that brokerages also have insurance. It's called SIPC for the brokerages, and that actually covers a higher level. It covers $500,000 in securities in a single account and up to $250,000 in uninvested cash that might be in that account. So I am kind of surprised, Kevin. I don't know if you've thought about this, but the FDIC, as far as I can recall, it's always been $250,000. I mean, I'm thinking back to even when I opened up my first like little savings account thing back in the 70s or the 80s. I want to say it was still $250,000. Like back then,
I just thought it was 100,000, but I could be wrong.
Oh, maybe. So they have raised it, but I am kind of surprised, given that SIPC is at basically $750,000 if you have cash in that account, that the FDIC is still only $250,000. But I think that's something that Congress will probably be addressing as we go forward, that maybe, the $250,000 is just a little bit too low now, but we'll see.
Right.
Yeah. So if you win that lottery, and you're going to be over the 250, then you might want to think about like what some people do. They do open more than one bank account. They have several banks, and they put the money into several different locations. And then that eases some of the risk too, that we saw with Silicon Valley Bank, that the depositors were heavily concentrated in that bank. Like they didn't have it as much moved in numerous different locations, although some companies did, like Roku and others did have in multiple banks, but still, yeah.
Yeah, but look how hard it was for Roku to diversify. Their
right,
nearly 500 million was 25% in one bank.
Yeah.
So this just illustrates the what a pain in the butt it would be to win the lottery, because you'd have to spend all your time opening new bank accounts to distribute it.
Right. Figuring it out. Right. I guess that saves me all that time and effort.
Yes.
Since I've never won the lottery. Okay. So let's go over a few of the tickers we talked about. There was Schwab, ticker SCHW. We talked about First Republic. That's the other big San Francisco bank that has seen its stock get hit very hard. F as in Frank, RC is the ticker for that one. Then we talked about Western Alliance briefly. That's where Citadel took a 5% stake. They're actually in Phoenix. Ticker WAL is the ticker. And we also talked about the regional bank ETF that Kevin bought on March 13th. That basic one is just the KR as in Robert, E as in Edward, KRE. And there's a couple others you could get into on the banks. There's one that's KWBR that holds kind of smaller banks. The average market cap in that one is $4.7 billion. And then there's one that's
an ETF.
Yeah.
Yeah. Okay.
And then there's one that's an IAT. It is. That one holds the bigger caps, and it's only 38 holdings in that one, and that one's been hit really hard in this sell-off. It was down 29% at its worst point, and that one is IAT, as I said. So, but the most common one is the one that Kevin bought, the KRE. It has over 140 holdings, and that is, the most diverse of them, I believe. So yeah, you want to be sure to subscribe, because I had no idea just a week ago we would be doing a podcast on the banks and all of this would be happening in such a short period of time. So you never know what we're going to cover on the Market Edge. But you can get us on Apple Podcasts, on Spotify, we're on Amazon Music, but be sure to get us somewhere, and I'll see you again next week with some more stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.